Hi, I'm Scott Robinson, Director of the REIT Center at the NYU Schack Institute of Real Estate. I also have the privilege of serving as academic advisor to our student-managed REIT Securities Investment Fund. This fund allows students to invest in U.S.-listed REITs, REOCs, and homebuilders, presenting them with an unparalleled insight into the challenges and rewards of investment management. Now that the fund has been up and running for a few quarters, we thought it'd be a good time to speak to other fund managers to learn more about their strategies, hear their thoughts about the evolution of the REIT sector, and discuss the current investment environment. We are fortunate enough to speak with three separate managers as part of the series we're calling Meet the Managers. They include David Auerbach of Hoya Capital Real Estate, Phil Bach and Ronnie Appel of Armada ETF Advisors, and Matthew Kirshner of Cohen & Steers. We appreciate their time and support and hope you enjoy these discussions. All right, well, we'll get started here. Thank you, everybody, for joining us. I'm Scott Robinson, Professor of Capital Markets and Director of the REIT Center at NYU Schack. I'm joined by Aaron Goldman, Head Analyst at the REIT Center's Investment Fund, and David Auerbach, Chief Investment Officer at Hoya Capital. David, it's great to see you. I've known you for a very long time, and it's good to have this conversation.
Scott, great to see you. Thanks for including me in this. I'm really excited for this.
Cool, my pleasure. Well, why don't we get started a little bit with your background? I know you've been in the REIT sector for quite a while. I was going to make a joke about how long relative to me, but I won't go there. A little bit about your background and Hoya Capital and what you're doing over there.
Obviously, I'm dying to hear your joke. I'm really curious. My name is David Auerbach. I've been in the REIT industry for 25 years. I got my start at Green Street, or what was then known as Green Street Advisors, on their trading desk here in Dallas. I started on the day the NASDAQ crashed in March of 2000, and I was on the Green Street trading desk for about 12 years, getting to basically watch the entire industry grow up. New companies, new managers, the ETF industry starting to grow up. I kind of got to sit in the driver's seat through the Green Street lens and participate in the growth of the industry. From Green Street, I joined a local broker-dealer here in Dallas, focused on ETF business. He was involved in ETF creation, redemption, seeding, relationship building, and it was also a trading desk. And so I was building out some of the REIT side of the trading practice as well. From there, I joined a broker-dealer out of Chicago, doing new issues, preferreds, REITs, MLPs, closed-end funds, a lot of the illiquid type securities. I left WEG, what was called World Equity Group, and then started up with the group at Armada ETF Advisors. We launched 2 ETFs in the course of my tenure there. And then I joined Hoya Capital in September of 23 to be the Chief Investment Officer behind his 2 ETFs, the Hoya Housing 100 ETF, ticker HOMES, HOMZ, and the High Dividend Yield ETF, ticker RIET. 2 completely different funds, 2 different focuses, 2 different sets of securities or universes to follow. But at the end of the day, it's all about income through real estate.
I appreciate that, David. Look, the industry has definitely changed and evolved over the past 20 plus years. So too as the capital markets and the broader macro environment. I kind of want to get into all that a little bit, but talk to us a little bit more about Hoya Capital, if you will. When were you guys founded? What was the background and how have you evolved over the years?
Sure. Hoya Capital started as a research platform on Seeking Alpha, which is still a very prevalent research platform there. There's a handful of obviously very well-known Seeking Alpha personalities that cover the REIT industry. But my partner got his MBA from Georgetown, launched the Hoya Capital Research Platform. And through the course of his research and growth of followers, it led to the birth of HOMES, HOMZ, which is in its 5th year of trading this year. As I mentioned, it covers all things housing. He got to kind of ride the success of the housing industry, the evolution, especially during COVID with the transition of what happened. The fund peaked out over $100 million in assets. And in that time, based off of investor demand, that is what led to the birth of RIET, which is in its 3rd year this year of performance. And again, we're trying to find the value, especially in a lot of the small cap, mid cap names that have a higher beta. There's a handful of mortgage REITs. And as far as I'm aware, it's currently one of the only, if not the only, REIT ETF that has a sleeve of both common and preferred stocks. And so since we have a focus towards, again, some of these yieldier type names, we are looking at something that's paying like a monthly dividend that's currently annualized over 10%, thus generating a lot of advisor interest and investor interest, especially with the 10-year treasury trading at 4 and change, the Fed funds interest rate at north of 5. But really, we're a two-sided shop. We're a research platform, and then we're an ETF issuer.
I noticed I noticed on your disclosures for holdings as of end of November of 23, you guys have a fairly high concentration in office. And being a income-focused ETF, how do you manage when these firms cut their dividend? Or do you not even look at them? And what's the thought process for that sector?
Sure. Obviously there's winners and losers in the office space. I'd much rather personally be the landlord of, let's say, One Vanderbilt or the Empire State Building than be the landlord of a Class C 1930s property that's, really maybe not going to survive the test of time. So if you look at the names in our portfolios, as you mentioned, yes, dividend coverage is something that's very important to us. We are a passive fund. We only do a semi-annual reval, but I do call us actively passive. As Scott knows, I cover the REIT industry on a daily basis through my newsletter, The Daily REIT Beat, plus my partner through his Hoya Capital research platform, that we're staying on top of these names every single day. So with both of our funds, because we are rules driven, our ETFs are rules driven, we have certain parameters that are in place. Really, the goal of REIT is a two-pronged rules approach. Number one, find the REITs that pay the highest dividends or have the highest dividend yields. But part two of that rule is that they have to have the lowest leverage ratios. So ideally, our sweet spot are the REITs that have the highest dividends with the lowest leverage exposure. And thus, in some names in the world of office or some of these other riskier sectors right now, we're kind of, I'd like to say, isolated because we cap our sector weightings, our constituent weightings, that even if one name does cut their dividend, hopefully we'll be ahead of that. We will have prevented that from falling into the portfolio. Or B, should it happen, because of the max exposure being anywhere from 1 to 1.5%, you will still be covered on 98.5% or 99 of the 100 names. Obviously, I can't control if a certain company announces a dividend cut tomorrow, even though we'd like to think that we are, able to kind of foresee some of that happening. But again, our goal is to truly provide a truly diversified, holistic portfolio that should there be one dividend cut, again, the rest of the basket would cover the impact of that one particular cut, if that makes sense.
David, I want to take that opportunity. Let's step back a little bit. Over the past 20 years, you mentioned the whole market has just kind of evolved a lot. But if I think back to, probably longer ago than that, the so-called REIT Mafia back in the late 90s, it was a handful of large REIT-focused mutual funds that were really kind of the dedicated capital to that small kind of emerging REIT sector. Can you talk to us a little bit about those players back then, how they were structured, how the REIT capital markets have evolved today to where you're now talking about actively passive ETFs?
Yeah, I mean, it's a great question because honestly, we wouldn't have a REIT industry today if there wasn't the REIT Mafia. If guys like Cohen and Steers and European investors and Fidelity and Morgan Stanley, and we know who the players are. And by the way, for anybody who's listening, there's some great books that have been published that kind of walk you through the history of the REIT Mafia. The first one I always recommend is Ken Campbell's book, Watch Out for That Rat Hole. He does a really good kind of like a first-person story of talking about the evolution of the REIT Mafia. Also, Sam Zell's autobiography kind of goes into some of that as well. Because of Sam Zell's companies and Milt Cooper, some of the original REITs being the pioneers to get this industry off the ground. So back then, especially being at Green Street, since Green Street was so well known for their research, we were working with the Cohen and Steerses of the world, the Morgan Stanleys, all of these funds, European or EII Capital, et cetera. And, if they gave the, let's say, the thumbs up on a deal, it wasn't just one guy investing. They were all investing into these funds. So like Simon and Kimco, like I said, if you look back on when these funds launched, within the first month, again, and I don't have access to this, I just know that all of those REIT investors came piling into a lot of these companies. Back then, it was really just the big 5 sectors, right? It was office, it was retail, it was apartments, it was malls. Well, now we have 15 different sectors or more that's out there. Even if you go back to the early 2000s, there was no data center REITs. There was no cell tower REITs. There was nothing like a cannabis REIT that was out there. Some of these new sectors have really kind of come along in the past few years. But in addition, it's led to new, call it new creative ways of financing. Back in my day, companies would just do overnight secondary offerings. That was par for the course. And now we don't see REITs do typical secondary offerings. Everybody does a forward offering, or they have ATMs. They always locked up at the market equity offerings and their share bank, and they could kind of issue shares at will. Preferred stocks used to be a really big, as I talked about, because we have preferreds in our fund, because the numbers unfortunately don't make sense for a lot of these companies to do it right now. The preferred market has kind of changed, whereas just a couple of years ago, and I used to be one of, not to pat myself on the back, I was one of the larger REIT preferred traders that was on the street. 75% of the companies had some type of preferred stock that was out there. It was a whole new universe. And we talk about the REIT Mafia. There was a REIT preferred mafia as well. So you had a handful of REIT investors, Cohen and Steers, Kensington, European, among others, that were solely invested in the REIT preferred stocks. And so it's just this evolution that we're kind of seeing. And now, debt is obviously has been then, it's been now. But if anything, one of the things that I've learned at Green Street, or going back to my days at Green Street, I'd want to say the publication goes back to 07, 08, when Green Street put out a monthly commentary urging the REITs to cut their leverage to sub 50%, go to 25%. And at the time, the industry pushed back on the publication. There's no way we can cut our leverage this much. It's not going to happen. And guess what happened? The industry completely turned around. They cut the numbers. So, it's an industry that continues to go through evolution. Look at AI as a good example. AI is impacting portfolio managers, property level operations. It's kind of trickling in, through various sectors that are out there. But I personally don't think AI is going to find the cure for cancer. So guys like Alexandria, I feel should still do well because of the collaboration in a lab environment, and using, testing is going to lead to those cures versus using AI generated. Or as another example, like schools, education. AI is not going to be a janitor and clean up a school, as an example, or a hotel room. So, that human touch will always be around. But it's a sector that's undergone a lot of changes in 25 years. And frankly, I see it undergoing many more changes in 25 years. A la the mutual fund, I think, is going away, period. You're going to continue to see many more mutual fund to ETF conversions. I think we'll see more ETF issuers come to market. The problem is that, especially in the world of ETFs, we have a very, call it, saturated asset class. If you have an idea for a fund, more likely than not, there's a product that already trades on the market. Unless you have something that's just so out of the box, right field, something completely different, it's a very saturated market. And so for anybody that's trying to tiptoe in that industry, we call it the Thunderdome, because you're basically entering the shallow end of the pool. It's better for us in the world of REITs and real estate because there's less funds that are out there versus a lot of the other sectors, but there's still a lot of funds, all things considered, in our little industry.
Right. I've got a few more kind of background and high level questions. Then I'll pass the mic back to Aaron to get into some sector and maybe some macro econ stuff. But my recollection is back in the day, there's a lot of back in the day in this conversation. REITs were thought of really as income vehicles. And then something happened to real estate, I think, in the post credit crisis, pre-pandemic era. Maybe it was driven by low interest rates. Maybe it was the expansion of the REIT and real estate sector into these other property types. But it started to feel like REITs kind of became like growth and thinking about higher returns as opposed to income-driven returns. But now, I don't know if it's just temporal where we are with interest rates, but it seems like people are thinking again about real estate as kind of income vehicles. Can you talk about that a little bit? Is my recollection of that kind of true? Is it different? What are investors thinking?
I think you're half right, to be honest. Yes, REITs have always been considered income, but for some of these other sectors like data centers, towers, et cetera, those have been some of those growthish type sectors. So I think REITs as a whole are still considered income vehicles, but some of the sectors could be, let's say, growthier than others. If you go back to COVID and you look at what the top performing sectors were, it was industrial, it was data centers, it was cell tower. But the top performing REIT, in case anybody forgot, was the gaming sector, like Vici Properties. And even though the Las Vegas Strip was closed and nobody was going to any of the properties, the tenants were still paying the rent to the landlord. So Vici was the top performing REIT. Again, another example of a sector that didn't exist 20 years ago that's coming to life now, especially as these gaming REITs evolve to more experiential type offerings. And so I do think that, regardless whether it's today or 25 years ago, from the traditional 60-40 asset allocation, where in the pie does it fit? REITs have still maintained its 5 to 10%-ish allocation, depending, but the terminology might have changed because now some REITs are lumped into the alternatives asset class. And then in some of these other income vehicles, the income bucket is comprised of commodities, utilities, MLPs, et cetera. And so it's a little bit subsector. Again, going back in time, REITs used to be part of the financials index in the S&P. And because the sector took a life of its own, it got broken out into its own index a few years ago as a standalone index in the S&P and some of the other index providers. Now, I was on record. I completely was wrong. I missed the boat. I was way off on my call. But I had thought that with the REITs being broken out of the S&P into its own standalone subsector, that we would have seen a whole bunch of new funds and new investors and stuff come to market. And that didn't resonate. That didn't happen, actually. So it's still, again, REITs are 30 names in the S&P 500. They're anywhere from like 5 to 8% of most of the major indexes that are out there. And so there's still going to be I wouldn't say they're a core component because 5% isn't necessarily core, but I don't want to trash other sectors and other industries that are out there. But again, looking at that pie allocation, where do Bitcoin or crypto funds or ESG funds fit in that allocation? And the answer really is, I don't know. Nobody has a true set allocation, but pretty much all of the big platforms do have a home for real estate, at least to the tune of 5%. So 25 years ago, 25 years forward, real estate from that income side will still be a core component of the portfolio.
Okay, that makes sense. Let me ask you a little bit about this then, active versus passive, and we'll call it your rules-based ETF investing. How is that today different than what we thought of as an active REIT investor, 10, 15, 20 years ago? What's the difference there? And how does that difference result in the ability to make or not generate alpha?
All right, so that's a great question. And it's difficult to compare, let's say, a Hoya versus a Cohen and Steers, because in our ETF, let's say we'll use Simon Property Group as an example. Simon in one of our funds may only be 200 shares, 300 shares of the whole portfolio of names, representing a tiny allocation. Cohen and Steers' same allocation could be the tune of hundreds of thousands, if not millions of shares of stock. And so for them to move it, sell it, buy it, transact in it, chances are they had to have the other side of the trade already lined up. You know, the sell side broker had to have the contra party. The company had to buy back the stock. Somebody was prop trading it, putting it on their books. It's just a little bit difficult for a company of that size to be an active trader and push volume through like that, unless you had, again, good relationships with your broker who has the relationship from the other side. And that was the stuff that we were doing at Green Street, you know, on the trading desk every single day, where we would get programs. You know, I've got here are 10 names to buy. Here's how much I want to buy. Here's 5 names for sale. Here's the limits. Here's how we're going to play it. If you sell, then go out and buy. You know, there was instructions that go with that. We're kind of in the same situation with our rules. You know, if we're going to sell this, we got to buy this. The stars have to line up. We can't just transact just to transact. And so pretty much that remains the same. But I think it's easier for an ETF issuer, again, because of the fact that if you're an active ETF guy, you're only really moving a tiny piece on the underlying constituents versus doing an entire portfolio reval, again, on a quarterly or semi-annual basis. But even then, you know, that really is, you got to go towards the big boys, you know, again, the Vanguards, the BlackRocks, those guys, you know, where they're still working with big blocks of stock. But what we were doing at our previous trading firm, when I was at the ETF issuer, if we saw a reval coming and there was illiquid securities, we had something that, you know, we had to rebalance, and the amount of stock that we had to buy or sell represented, let's say, 500% of the average daily volume, or 1,000% of the ADV, meaning I've got 10,000 shares of this to sell and only trades 1,000 shares a day. What do I do? And if I put that reval in on that 10,000 shares on a thing that trades 1,000 shares, you're going to drive that thing well lower, which is going to blow up the NAV of the ETF. And instead, what we used to do was what we call tiptoe. We would leg into the trade 3, 4, 5 days, 10 days, depending on what it was on the liquidity. So again, using that 10,000 share example, we would trade 1,000 shares, 1,000 shares, 1,000 shares, 1,000 shares. And then on the actual day of the reval, we only had to have 1,000, 2,000 shares to actually transact in. And then we would package up all of those executions, if that makes sense, and then say, the average price in the 10,000 share rebalance was really this, even though we had started it several sessions in advance. I think to go back to the end of the day, though, the sell side relies on the buy side. The buy side relies on the sell side, at least when it comes to volume, in my opinion. And for those that don't know, the sell side produces the research. They sell the research. The buy side investors, they're the one that buy the research. They are paying for the research through to the broker in terms of trading. They're paying their trading dollars, or investment banking dollars go through to pay for that, to get access to the deal. So I was a sell side broker working with buy side customers to try to transact, buy and sell names across the buy side. You know, Cohen and Steers is buying, Morgan Stanley is selling, put the trade together.
Speaking of active management, back to your ETF, can you talk a little bit about what inputs help inform your decision-making for sector weightings?
Yeah, it's a great question. We try to take a holistic approach where I want to say we'll kind of equal weight all the sectors, because there's just so many names and stuff that are out there. Some sectors are larger than others, so it kind of takes into account our weighting. We don't market cap weight our portfolio. So if we're going to say that we're going to be, just I'm throwing hypotheticals out at you, a 10% allocation to storage, we're not just going to put public storage at the top because it's the largest weighting and we can easily do that. That's where we're going to go in and actually try to figure out what's the best name. Do we want to own National Storage, or do we want to own CubeSmart, and why? So we try to take a sector by sector approach, then look at each individual constituent, meaning we care about all the metrics, all the ratios, all the fun stuff, price to FFO, price to AFFO, earnings multiples. We care about the earnings, the debt maturities, the dividend strength and coverage. I don't necessarily say we rely on what the street says. It's kind of a good tool to have to know what the general consensus is. But, I don't want to knock the street because I love the street, but think about what a typical Wall Street model looks like. And Professor Robinson, you know about this. A typical model could be 10 tabs on an Excel spreadsheet, 1,000 lines down. It's a massive, complex spreadsheet, but a portfolio manager, or excuse me, an analyst can go in and change one cell by 1/10 of a basis point, which has a corresponding effect on the NAV. And so those numbers can be, I hate to say it, but those numbers can be easily manipulated. And so, you kind of have to figure out who's on top of it, who isn't, what's right, what isn't right. And nobody's perfect at the end of the day. But if we can kind of use some of these touch points to try to figure out what's moving the needle, I think that's the key. Is some sectors move the needle than others, and because we've moved away again from the office, apartment, strip centers, the original sectors, and seeing all of these other sectors that are out there, that's opportunity. In the same breath, though, mortgage REITs is a good example. There's a difference between obviously owning, a commercial mortgage REIT versus a traditional mortgage REIT. And then how do you play that? And what's the best? Now, personally, from where I sit, I've never grown up playing in the mortgage REIT industry. Green Street never covered the mortgage REITs. In all the years, I've only traded mortgage REIT preferreds. And, my partner, he's the one that focuses on the mortgage REITs, because if it's me, I'm talking to investors saying, focus on the big boys. Go look at Annaly, go look at Starwood, go look at Blackstone. If you're going to play mortgage REITs, stick to the big boys, because, I hate to say it, but if they go under, we got much bigger issues going on out there than just Blackstone's mortgage REIT and Starwood's mortgage REITs going under. Now, here's the problem. People are out there talking their book every single day. You have to kind of beware of what you're seeing on CNBC and Bloomberg, read between the lines of what the analyst's saying. As an example, again, I'm not knocking Muddy Waters, Carson Block. He's been around the block a long time. No pun intended. But, he is out there saying that Blackstone Mortgage Trust, BXMT, is one of his top short picks right now. And, another example, and again, I don't, is Equinix, what's going on with EQIX in the data center world right now. We happen to have just bought Equinix in one of our funds just last week as all of this stuff was coming out. Is that bad timing on our part? Is that good timing? Again, I don't have the crystal ball to know the answer to that. But if the numbers line up, we want to try to, again, put our claws on it at the right time. REITs are not day traded vehicles from where I sit. So when you buy a REIT, you're buying a REIT for the story, the long-term buy and hold strategy. REITs are, you put them in there, set it, forget it, again, assuming everything plays right, but you sit it and collect that passive dividend income stream from here, frankly, to eternity, and let these companies do what they do best.
I have a couple follow-up questions along this process, and I'll start with how you weight valuation into your process, and which you put more emphasis on, whether it's cap rates for NAV, FFO, or FFO growth. Can you just talk a little bit about that as well?
Yeah, they all go into our output to generate call it the perfect portfolio, the ideal portfolio. But by and large, we aren't necessarily putting, let's say, a weighting on the price to FFO multiple came in here, we give it a score of X. The price to FFO multiple came in here, we're putting a score of X. The cap rate on the portfolio, again, there's a lot of moving parts that go with this. And I think especially when you're looking at our REIT fund, when we're focused really as our top primary rules of dividend growth and leverage exposure, a lot of the other stuff at that point kind of becomes noise. And it doesn't hurt to have the arrow in your quiver to know the data points that are out there, but you can get really lost in the weeds very quickly if you start going down the rabbit hole. And so I think from where we sit, we have to kind of take into account all of those things that you're talking about, but we're really not, um, oh, well, the cap rate moved by 0.2 of a point based off of this guy's model, which therefore causes the NAV to move this. Do we need to add to our weighting? I think we just kind of take a further step back and say, has the general thesis of the story changed? Has something happened with its competitors, peers, industry that we need to be on watch alert? As an example, the retail space. You know, the retailers also, if you ask any of the retail REITs, if you go back and watch the retail REIT earnings calls, you know, every single company gets asked, which retailers are on your watch list? Who are you concerned about going under? What percentage of the rent do they represent in the total portfolio? As an example, like Party City is one of those companies that the retail REITs get asked about a lot. And so, you know, do we care about that stuff? Yes. Is it keeping us up at night? Not at all.
I'll follow up with one more, even more granular question, and that's back to the office sector and your bullishness on Sunbelt and New York City. I'll focus specifically this question on the Sunbelt and how your firm is bullish and does not have any exposure to Cousins properties. And I would look at them as one of the premier office landlords in that sector and region.
Yeah, and we like Cousins too. Obviously, I'm biased. I'm here in Dallas, Texas, so I know Cousins very well. Colin Connolly and the team, what they're doing down in Austin, everything. Frost Bank. I mean, I've grown up with Cousins through my entire career. It's a great name. But based off of the rules and all the other stuff, it just didn't make the cut in this particular go around. It's not because we have a bias against them. It just the levers didn't line up for them this go around. Does it mean that it's not going to line up for them in June or at our next rebound? No, not necessarily. But at the current time, based off of the from all the other levers that are out there, it just didn't make the cut. But again, you know, I'm again based in Dallas. We're not a very pedestrian friendly town like something like Manhattan is. And so you got to drive from building A to building B. You can't just walk 5 blocks and you're at the next big property. So as an example, this past Friday, I was at a building about 10 minutes from where I'm sitting right now. And it's one of like literally the only office buildings in this hoity-toity part of town. And it's at the intersection of what I call Main and Main, or just by the intersection of Main and Main. A very desirable asset. Not owned by a REIT, it's privately held. The building occupancy is maybe 80%, you know, they've got 80% leased, but the physical occupancy is like less than 50%. So even though you still got the best of the best properties in this desirable area, it doesn't necessarily mean that people are coming back in to the building more than they were, let's say, several months ago. But we know that work from home is still kind of here to stay in some form or fashion, that I don't think that building is going to see 80% physical occupancy, no matter, frankly, what tenant amenity offerings the landlord puts in place. Again, Dallas is not we don't have a great train system. It's growing, not quite what New York has or some of the other markets, you know, so come back to me in 25 years once everything has kind of evolved to where you guys are today in your neck of the woods, you know, and hopefully we will have our own one Vandy type situation here where it's the best of the best with a transportation hub going right into it.
Let's kind of think about the future a little bit. There's been a lot of talk post-pandemic about secular changes in addition to, of course, to some cyclical aspects, particularly interest rates. Are you seeing anything really kind of dramatically changing across the real estate landscape that could impact what real estate looks like and real estate investing looks like, you know, over the next 5 to 20 years?
I mean, as we talk about, AI is clearly playing into the evolution of real estate. You know, a lot of these companies have been around for 25 years and more, and they're going to be around for another 25 years unless they go out through M&A situations. A lot of these teams have the same management teams in place through that course of time. And one of the things that I personally love about the REIT sector is because these companies have dealt with a lot of obstacles in my particular career. Long-term asset management, COVID, 9/11, the housing crisis of 08, 09, 13, 14, the housing resi crisis, et cetera. I think a lot of these management teams kind of go back to the drawing board. What worked? What didn't work? What do we learn? Where do we mess up? When do we go on offense? When do we go on defense? When do we deploy? When do we not deploy? And so I think because a lot of these I'll never forget Eric Bolton. He's the CEO of Mid-America, and I did an interview a couple of years ago for the guys at Armada when we were there, and I asked Eric, "What keeps you up at night?" And he goes, "How do we keep finding ways to grow our dividend? How do I keep growing my dividend?" So these management teams, again, we have no control over our stock prices. We have no control over where interest rates are, where the 10-year trades every single day. Every single management team or myself as an ETF manager, all we can do is put on the blinders, focus on operations, ignore all the noise that's being thrown at us out, left and right, and focus on my operations. How do we grow revenues, minimize expenses, grow net income, grow our dividend payout? And I think if we can keep focusing on dividend growth or income growth, well, everything else will kind of fall into place. So I think that to answer your question, Professor, I think that, the focusing on operations, that's not going to change. I think we're going to see more tools come to market to help these guys make operations a little bit better. Like, let's use smart technology for apartments as an example. 10, 20 years ago, there was no Ring doorbells. There was no smart appliances, et cetera. And that's just, again, another piece that these companies have been able to use to save a few bucks on expenses, really, at the end of the day. That's money that's back in their pocket because they turn off the community lights at a certain time. Or, we're able to do a unit upgrade, a renovation upgrade, and we can push our rent on that particular property an extra $200 a month because we put in all of this new technology, which makes it more desirable for the next tenant to come in. So we continue to evolve. I'm just curious, what new sectors are we going to see grow up? I don't know the answer to that. If I did, I'd be in Fiji right now, trust me. But I think, look, a great example is the mall industry. Look at how outdoor malls have evolved over the past 25 years. We still have some very famous, well-known indoor malls that have stood the test of time, like Sawgrass Mills, the Forum Shops in Las Vegas, just a couple of examples. Whereas the traditional mall concept has completely evolved. It's not what we're used to now. What does that mall look like 20 years from now? Again, it could be, another evolution of this space that we're talking about here. I just think it's, Simon's dealt with these properties issues over the past 20 plus years, and they're going to continue to deal with these issues over the next 20 plus years.
That's a great point. And let me flip this a little bit, put you a little bit under the spotlight. Take that same answer and apply it to REIT fund managers. How is your space evolving? Has the REIT investment management business become more about gathering AUM, cutting expenses? Talk a little bit about what that landscape might look like in the next few years.
It's a great question. And I think you're right. I think it is going to be, when I started in the world of ETFs 13 plus years ago now, it used to be, what's your ticker? The ticker kind of generated your success. Good ticker drew in AUM. Then it's, what's the fund name? How much AUM do you have? How much do you charge for the fund? Performance didn't really matter. It's how much assets do you have, what's your dividend, and how much do you charge? So I do think we're going to continue to see that evolve, especially because we're going to see more people coming into the market as these mutual funds continue to convert to ETFs. I think at the end of the day, it's all going to boil down to fees. Nobody is going to be able to compete against Vanguard because, again, they're the biggest of the best and whatever. But whether it's myself or the other couple of fun guys that you're doing this interview with, what do we have that Vanguard doesn't? Call up anybody watching this, call up Vanguard and ask to talk to the REIT portfolio manager. Ask the guy who controls real estate. And they're going to be like, who? There is no person. Versus call up Hoya, call up Armada, call up Cohen and Steers, call up your favorite, real estate fund manager, and you will get that person on the line to answer your questions. And I don't think that's going away. AI is not going to replace me when it comes. AI doesn't have the passion about this industry, frankly, like I do. AI is going to assist portfolio managers in their fund selection, and again, I know, pause. I know we're editing some of this. Can I mention Arialgo without mentioning Arialgo? You know what I mean? Like, Arialgo's got the fund management platform that's going to help fund managers when it comes to AI type stuff as an example. So the industry will continue to evolve, but I think at the end of the day, networking doesn't go away. Networking isn't replaced by AI. Me talking to a prospective investor, grandma and grandpa in the villages, a portfolio manager in New York City, an advisor with Stifel in Chicago. AI isn't going to replace that. That physical face-to-face NYU's REIT Investor Day at the Schack Symposium. AI is not going to replace that. There's still huge knowledge to be earned from these leaders and gained that technology is not going to replace that.
Amazing. Thanks, David. Aaron, you want to take us to the last question?
Yeah. This is more of in my self-interest and the self-interest of my fellow classmates. Can you share a little bit about any advice that you have for us, for whether it's specific to the public equity markets or just in the real estate sector in general?
You could do a whole panel or a whole presentation just on this one question alone. And Scott knows how I feel about this particular topic. And I think I had started out our conversation this way. The one thing they don't teach you in a textbook is networking. Looking back on what I know, a lot of the stuff that I learned wasn't through a textbook. It was interaction with my classmates, my peers, my colleagues on the trading desk, these companies that I learned from every single day. But that all comes through networking. And so what I would urge all of your colleagues is that your peers are your future clients, your partners, your bosses, your investors. This network that you're involved with right now is going to be your future tomorrow, if that makes sense. Real estate is still tried and true. Bricks and mortar, look, see, feel, touch, smell. That's not going away. The metrics aren't going away. But the people that run these companies that are in these positions, that is what's going to continue to evolve. And so I think it's very important to get involved, learn about these companies, pick up the phone, ask questions, listen to the earnings calls, reach out to investor relations teams, go look at the local properties, be an active investor with your own eyes. Really wrap your arm around these leaders that are in your backyards or in your various cities. Get involved with your local schools, whether it's, for me, University of Texas at Dallas or Southern Methodist or TCU. Get involved with these programs. Professor will say, and I'm a big believer, that there are so many people that paved the road for me to get to where I am today. None of this would be possible where I'm at if it hadn't all started out with my peers at Green Street. Did my tenure at Green Street end on the greatest of terms? No. Am I in bad water with them, bad blood? Not at all. I'm still very close to a lot of that team. But I pay back what it's due because I know where I am because of my time at Green Street and my mentors that paved the way to help me get here. And how I pay it back is to help the next generation of leaders, help you guys get to where you guys want to go, because you are the guys that are going to be running Cohen and Steers and Fidelity and Simon Property Group and Kimco in the future. And so if we're able to help shape your minds about what we've learned through our experiences, then we continue this perpetual networking growth where I remember him. He ran the NYU Student Fund, and now he's the CFO at Kimco. Wow, what a great opportunity that he's gotten to grow up on that ladder. And it's all because of networking. So that's my big advice, is that don't stick your head in a textbook. Get out there and interact with your peers.
Always great speaking with you, David. I appreciate your insight and definitely your time. Thanks for chatting with us today, and look forward to talking to you more later.
Scott, thanks so much for having me. And again, if there's any questions, please don't hesitate to reach out. I really appreciate it.
You got it. Will do. Thanks.
Thanks.